90% of traders fail due to a lack of edge, when they thought they actually had one. Here's how to identify and prove your edge with these 7 useful tips from world-renowned quants such as Jim Simons. I'm Manir, also known as Ghost Trades, and I also run unbiased trading. Let's get straight into this. Now, my apologies for sort of a weird background, the whole weird setup. Currently, I just moved to Dubai, and I'm still kind of in a hotel apartment. So I'm sorting things out, but I wanted to still, keep to my consistent kind of upload schedule of at least once a week. So I hope you still find this video, valuable and useful to your trading. First is past performance is the best predictor of success. Now, this quote is obviously by Jim Simons. I've quoted it a lot of times. Now, this is the foundation of around 90 or so percentage of edges, bringing the importance of actually having access to quality historical data and to be able to test your ideas on it. Without historical data, there's no really easy way to actually test an idea and to get quantitative kind of like performance metrics about an idea before you take it live. It's the most scary thing and also really bad for conviction to just take a strategy live that you have no sort of proof or even evidence that this could be something that's profitable. And also there's just so many other metrics you learn about, like, max drawdown, average drawdown, all those kind of things that teach you a lot about a strategy. Whereas if you're only doing forward testing or just, deploying it straight away, you won't know any of those beforehand, which can really cause issue when you're actually trying to run that strategy and when you want to do optimizations and things like that. Next is we don't override the models. Now, this is also by Jim Simons and is one of the most, I think, basic yet incredibly difficult to actually pull off things to do. So primarily what this means is just to have accurate comparison and analysis. You need to stick to your system. Without it, you can never make an actual scientific decision about your system because you've gotten into the way of your system and changed some kind of variable that you weren't expecting to change. That makes it very hard for comparison to either your backtest or whatever you're doing for the comparison side of things. Now, most of the time here, what I would say here is use less size, because if you can't compare and if you can't actually gauge based on your backtest how well your strategy's done in a forward performance or whatever, like the two comparisons, that's going to cause the most issues. And realistically, you've just wasted time because you actually can't compare anymore. So there's not really any scientific decisions or conclusions you can make. So use less size and be able to fully stick to your strategy playing out, and at least give it a month or 2 months to see how the performance is. Now, I will actually say on that, maybe you don't have to do a month to 2 months if you have a super high sample rate, but you also want to incorporate multiple market cycles. So if for some reason you have a crazy strategy that has a lot of trades and you went over like two market cycles in a month, then I guess you could a month could be perfect. But most of the time, at least from my findings, it's been about a quarter or so. So that I want to let it run, and then I can make decisions based off that. Next is we have free criteria. If it's publicly traded, liquid, and amendable to modeling, we trade it. This is a really good lesson. This is also by Jim Simons, but the lesson here is that don't try and trade things that you don't have these kind of free criteria for. Now, obviously, publicly traded, if you're institutional, things like that, then that necessarily doesn't apply as much to you. But you want things to be a liquid, and you want them to be able to have data that you can actually source and test over, so you can have more scientific approach to your actual trading and be more systematic. I will say liquid is an interesting one. Liquid really applies to when you're growing account, but there are some really good edges that are more illiquid that are perfect for smaller accounts and can actually have like a really decent return. So this does depend. I would say obviously for scaling you want it to be liquid, and that's kind of why he's mentioning obviously you want a liquid market in it. And personally, from my experience, the best kind of way to go around there is like futures and things like that. They're incredibly liquid. You can put in a crazy amount of size on relatively easily, compared to even some equities is harder to do than in futures, for example. But a really easy case of like OTCs, they actually do have edge in the right market regimes, but they are often quite liquid. But that doesn't stop people from making substantial amount of money just because they are liquid as well. So multiple ways to go around this idea, but I think these three are really key. And one additional point I actually wanted to put here was a lot of people ask me about float and short float and things like that. Those are metrics or data points that are very hard to actually source historically, at least source accurately, at least from my findings. And that sometimes you kind of have to do two things. You can either track it manually, which I think you should do anyway. Like if you want to see the performance difference between a different data point, then track it manually if you can't get it historically. However, don't put an over reliance on that particular data point. That's at least what I do. So I will be aware that if a stock has less than, like a million float, and it's also if it's from China, then, I'm going to be more aware of my risk management on that particular trade. However, that doesn't mean I'm totally turning off that trade just because it has below a million float, because I actually don't have enough data to really tell me if below a million float really affects my win rate, my performance, all those kind of things. So be able to, adapt to them slightly, but I just would say don't put a huge reliance on them or make your whole strategy around that one metric that is really impossible to find historically accurate data on. Next is I get real concerned when I see trading strategies with too many rules, and you should too. This is actually by Larry Corners, and this is just regarding the most common issue in trading, which is overfitting. And this causes unsuccessful live strategies because you've overfitted onto historical data most of the time because you've added too many parameter counts, too many optimizations, things like that. And this really just is a really simple lesson of focusing on simplicity and make each parameter count. You don't want to be adding new parameters if you're only increasing your performance, let's say, by 2% or something. Realistically, that isn't normally, at least on my strategies, worth it. However, it does depend on what you're optimizing for. If you're, trying to reduce drawdown as much as possible and you introduce a parameter and it doesn't really increase your profits, but it reduces your drawdown by 10% or something, then that's a substantial move, and that potentially could be worth having that extra parameter, even though you know that you're adding extra risk of overfitting. So that's what I mean when I'm saying make each parameter count and make it, valuable, and that's why it's staying there. 5. Patterns of price movement are not random, however, they are close enough to random so that getting some excess, some edge out of it is not easy and not so obvious. This is also by Jim Simons, and I think whenever I read this quote, I always just think it's about the amount of times you're testing ideas. You need to be ready to test hundreds of ideas before you actually find one that actually works. So just keep testing new ideas, and obviously, I think there's actually a quote after this around this, but it's around edge decay, that even when you find one, you'll probably need to start finding a second, because potentially that first one could edge decay over time. You never know. Some markets are great, like small caps personally, at least from my findings, haven't consistently become worse. They've actually, they've got better and they fall out of cycle, but there have been edges, and I do know edges of other people's as well, that have just completely disappeared. A lot of them were from the 2020 times, where you could do a lot of long kind of strategies that just have completely disappeared, at least at the moment. But they do potentially come back in the future. Most of the time, they don't fully disappear. Well, that's not actually true. A lot of market making strategies back in the day have completely disappeared because the markets have become more efficient. So they can fully disappear as well, but I think for most people, they may just fall out of favor and then kind of come back later on when that kind of market regime works again. But yeah, just get ready to be testing a lot of ideas. I had to test hundreds just to find like a couple of good ones. So just be expected with that. Sometimes you can get lucky, like in small caps. I think the edge is so obvious, you kind of know what to test first. But then it's kind of refinement from there. So it's a lot of refining and a lot of different potential data points that would actually make more sense to apply to those kind of strategies. The system is always leaking, and we keep having to add water to keep it ahead of the game. This kind of means two things, really. So one, referring to what I did before, what I mentioned before around edges decaying, so no longer working or falling out of favor. You kind of need to constantly research and add new ones, so you kind of keep ahead of the game. And two is refining those strategies and optimizing those strategies over time. For this reason as well, it's crucial that you build a portfolio. Ideally, you want an uncorrelated strategies all put into a portfolio that will also match well together, so like a mean reversion, trend following, things like that. And those can be an incredibly powerful system, and that's what the best kind of quant funds do. So ideally, we want to aim towards that, where we have multiple strategies. They don't all have to be, the holy grail strategy. Personally, I don't think it really exists. They can be more mediocre or just above average strategies combined together to make something that's really good. And 7, in this business, it's easy to confuse luck with brains. This is also by Jim Simons, and there are a multitude of biases in trading affecting the way we react and process information. Recognizing these biases, like recency bias and survivorship bias, is crucial for success. I think this also touched on the topic that you may take a trade one time and it will work out incredibly well, but at the end of the day, it could have just been luck. You could have just taken, for whatever reason, that was the one trade that went 10x from your entry. That doesn't necessarily mean you found an edge or you found something that's actually repeatable. So just keeping that in mind is incredibly important. And also, it's important when you're actually in a strategy and you know a strategy has an edge, but then one of the trades, I'll take an easy example from my own experiences. I shorted one stock and I think it went down 60% or so in a day. Nothing around that was actually my strategy doing on purpose or a refinement I made to find that particular stock. It was just one of the trades in that strategy, and it was one of the bigger winners. Obviously, you can look into it and see if maybe there's something that's similar on all of those, and you could refine your strategy. 100% that can happen, but sometimes it is also just pure luck, and that was the one trade that faded 60%, and you're having a huge gain. So don't over confuse your luck basically with brains, as he's saying. Thank you for watching, and if you enjoyed, please like it and share it with anyone else who might be interested.